We're seeing some epic changes in the economic markets globally. For months, there's been all this turmoil in financial markets and a growing sense of stress in our world economy. Stuff for the history books. You might think this is just the normal signs of a bear market and a coming recession, but it's also this painful growth, this emergence of a new regime in the world economy, and a shift that could be pretty consequential. If we had the rise of Keynesianism after the Second World War and a pivot to free markets and globalizations in the 1990s. Stuff is changing like that now. So this new era has promised that the rich world might escape the low growth trap that was in the 2010s, and we could tackle big problems like aging, getting older, and climate change. But it also brings a whole bunch of real dangers, financial chaos from broken central banks and out of control public spending. These changes and stuff in the markets, it's a magnitude we haven't seen in a generation. Global inflation is in double digits for the first time in 40 years. We've been slow to respond, and the Federal Reserve is now cranking up interest rates at the fastest pace since the 1980s. While the dollar is at its strongest point since the past 2 decades, it's causing chaos outside of America. If you have an investment portfolio or a pension, this year has been pretty gruesome. Global shares, they've fallen by 25%. In dollar terms, it's the worst year since at least the 1980s. And government bonds are on their course for the worst year since 1949. Along some $40 trillion in losses, there's a scary sense that the world order is being upended as globalization heads into retreat, and the energy system gets fractured after Russia's war in the Ukraine. All of this marks an end to the age of economic peace that we had in the 2010s. After the global financial crisis of 2007, the performance of rich economies kind of fell into a weak pattern. Investment by private firms was limited. Even while they made monster profits, governments didn't really pick up the slack, and public capital stock actually shrank all around the world as a share of gross domestic product. 10 years after the Lehman Brothers collapsed, nothing happened. Economic growth was really sluggish. Inflation was low. With private and public sectors doing little to stimulate more activity, central banks became the only game in town for growth. They had held interest rates at rock bottom levels. They had to buy huge volumes of bonds at any sign of trouble. That extended the reach further into the economy. Now, on the eve of the pandemic, central banks in America and Europe and Japan, they owed something like $15 trillion in financial assets. The extraordinary challenge of the pandemic led to extraordinary actions that helped unleash the inflation we have today. You have wild government stimulus and bailouts, temporarily skewed patterns of consumption, consumer demand, and lockdown-induced supply chain tangles. So this inflationary impulse we're seeing has been turbocharged by the energy crunch with the Russian war in Ukraine. It's one of the largest exporters of fossil fuels along with Saudi Arabia, and it's isolated itself from markets in the West. So faced with a serious inflation problem, the Federal Reserve Bank has already raised interest rates for a maximum of 0.25% and is expected to go up to 4.5% by 2023. Globally, monetary authorities are starting to tighten too. So what the heck comes next? So one immediate fear that is out there is of a blow-up where the financial system has become so used to low rates, it wakes up to the soaring costs that we have of borrowing. Now, Credit Suisse, that's under pressure, but it's a mid-sized lender. It's unlikely that other banks are going to become a big problem because we have bigger safety buffers than we had in the past. Instead, the dangers are elsewhere. You have a financial system that relies less on banks and more on fluid markets and technology. The good news is your deposits aren't about to fade away and disappear. The bad news is the system for financing firms and consumers is opaque and hypersensitive to losses. We can already see this going on in credit markets. We've got firms that buy debt, but they're shying away from risk. The interest rate on mortgages and junk bonds is soaring. The market for leveraged loans used to finance corporate buyouts is kind of tied up. Elon Musk bought Twitter, and he might have to declare bankruptcy because that is a problem. Then you've got investment funds, like pension schemes. They face losses on their portfolios of liquid assets that they built up. Parts of the plumbing for money could stop working. The treasury market itself has become pretty erratic. And European energy firms, they've got crushing collateral calls on their hedges. Britain's bond market has been thrown into chaos by obscure derivative bets that were made by its pension funds. Now, if those markets stop working smoothly, that can impede the flow of credit or it can threaten contagion. Then central banks might have to step in. Already, the Bank of England has done a U-turn. They started to buy bonds again. cutting against its simultaneous commitment to go out there and raise rates. The related belief that central banks will not have the resolve to follow through on their tough talk is another big fear. Then we could see stagflation, a return to the 1970s. You have rampant inflation. This might be like a little alarmist, but most forecasters out there think that inflation in America is going to fall from like 8% down to 4% by 2023 as energy price rises ebb and higher rates bite. While the odds of inflation going to 20% are tiny, there's a big question about whether governments and central banks are strong enough to bring inflation down to 2%. This is like a moving target. To understand why, you got to look far beyond the chaos today to long-term fundamentals. In the big shift from the 2010s, there was a structural rise in government spending and investment underway. Older citizens need more health care. Europe and Japan are going to spend more to defend against counter threats from like Russia and China. And there's this look for security is going to boost state investment in energy, from renewable investments, renewable infrastructure to gas terminals. In geopolitical tensions, they're leading governments to spend more on industrial policy. But even as this investment rises, our demography, how old we are, is going to weigh more heavily on rich economies. As people get older, we save more, and this excess savings is continuing to act to depress the underlying real rate of interest. As the result, the fundamentals and trends in the 2020s and 2030s, they're for bigger government but still low real interest rates. And for central banks, this is a pretty big dilemma to try to solve. If you want to get inflation down to the target of 2%, you might have to tighten enough to cause a recession. And this would be a high human cost in terms of like job losses. It could trigger a huge political backlash. Now, if the economy deflates and we end up back in low growth, the low rate trap that we had in the 2010s, central banks might once again lack enough stimulus tools to fix it. The temptation now is to find another way out, to ditch this 2% inflation target of recent decades and try to raise that inflation to 4%. That could be on the menu when the Fed reviews its strategy in 2024. So this brave new world of somewhat higher government spending and somewhat higher inflation would have advantages. In the short run, it means a less severe recession or none at all. And in the long run, it can mean that central banks have more room to cut interest rates in a big downturn. And that could reduce the need for bond buying and bailouts whenever anything goes wrong, which could cause an even greater distortion of the market. But it all comes with pretty big dangers that we've all got to think about. The central bank credibility is going to be damaged. If you move the goalpost once, why not do it again? Why not go for even higher inflation? You've got millions of contracts and investments that are written on the promise of 2% inflation. Those would be disrupted, while mildly higher inflation would redistribute wealth from creditors to debtors. Meanwhile, the promise of moderately bigger government could easily spiral out of control if populist politicians make reckless spending pledges, or if state investments in energy and industrial policy get poorly executed, get screwed up, and bloated vanity projects start to drag down productivity. These opportunities and dangers are kind of scary, but it's time to start thinking about them and their implications for you, for me, for citizens, and for businesses. The biggest mistakes in economics are failures of imagination that kind of reflect an assumption that today's regime is going to keep going on forever, but it never does that. That never happens. Change is